Okay, nothing should come in as a patchwork later. Okay, whatever comes in as a patchwork later, will mess up your functioning of the laboratory at a later point in time. So it is better to take all these things upfront, as you are planning. Medical and allied equipment, you need to budget for that. A professional fee, for consulting or for municipal permission. I have come across 1 or 2 projects in Bombay where the project could not take off because the municipal fee was very high in terms of getting permissions for changing, for making structural changes in buildings. It's not very easy. Okay, so if you have some rule like that in I think Hyderabad is another town where it's very difficult to get permissions in certain ways if you want to do structural changes. Pre-operative costs, and interest during construction. This is called IDC. When you take loans from banks, you need to start paying interest, immediately. The principal, perhaps they may give some kind of a moratorium for a year or 18 months, but you need to capitalize that interest when you are doing a project report in terms of a spreadsheet. Then comes the departmental income. Okay, so whatever departments you generally have, you need to come up with income assumptions. So that assumption, I think you perhaps would be able to do it better because you know the market generally. So you would say biochemistry, number of investigations, so much on an average cost, which be so much. Okay. Similarly for microbiology, histopathology, various other tests that you have. Mind you, these assumptions have to be realistic. Do not generally make assumptions for the sake of submitting the report to financial institutions only, because you may get into serious trouble, if you don't meet the projections that you are giving. And now, because of so much of private equity investment and interest in healthcare, and especially in your field of diagnostics, where valuations of entities have gone into maybe even 1,000 crores kind of thing. I think Dr. Lal got a valuation around that. So that has made a lot of interest in the field. So whatever projections you give are going to be seen by a microscope, because they already have the data of people who are doing these kind of things. If you've heard of CRISIL, CRISIL comes out with a report every quarter, which gives you productivity, income, profitability details of healthcare entities every quarter. Okay, so this is extremely important, that assumptions need to be practical and realistic. Okay, many a times we do the mistake of making it for the financial institution for debt funding, but then later on, we end up into trouble. Break the incomes maybe as walk-ins and referrals, because walk-ins generally you don't have that referral component, which is in debate recently, that whether you should take or not. That's up to us whether we take or not. How you treat it is also entirely up to you. If you are going to entertain that, then you need to, in expense sheet, mark that as a referral patient and mark out the referral which goes out. Research for industry benchmarks for rates and volumes. Mind you, volumes help you to tweak the rates. Okay, that's something which has been done, I think, by ThyroCare, or even in medical cases. I remember we once did a report for House of Tatas, where we made a report for Tata's investment into healthcare to put up 20,000 beds in 7 years, across India. So they were either going to be 20 hospitals of 1,000 beds each, or 10 hospitals of 2,000 beds each. But the idea was, with high volume, I will lower the cost. What Dr. Devi Shetty does, say for example, with his cardiac model. He still does bypass surgeries which are 120,000 or 150,000 or even lower, than that. Or Arvind Eye Care model, where high volume throughput, and you are able to do cataract operations as low as maybe 1,000 rupees or 500 kind of rupees. So if that's the kind of thing, then you need to understand that model, whether it's going to work or not. Okay, this hospital which I mentioned in Ahmedabad, the Asian Bariatric Center, is exactly opposite. They wanted to only treat the class which is on the top. All right, so that's maybe something like a Fortis model, where you only target certain segment and do that. So you may think of that, I would do only those kinds of tests, and just stay there. I will not do the bread and butter where competition is very stiff. So those kinds of things need to be researched out, through industry and benchmarks and other things. Provide for concessional investigations. If you are in, say, business of offering some charity, then you need to provide for, that you just can't start a for-profit thing and then start giving, charity. Generally, we, calculate all assumptions on 100% capacity utilization. So I will say that whatever assumptions I am making is when I am at peak. Okay, so what I'm trying to tell you here is that suppose I do I'm giving a simile because, laboratory I may not be able to tell you exactly. It's like a 100-bed hospital, so I am saying 100 beds occupied and this is my room revenue. Okay, so like that you have to calculate, and then you do a discounting year-wise. So then I am going to say in year 1, suppose it was a hospital, I will do a 30% occupancy in year 1, then 40, 50, 60, like that. Because it's generally easier to calculate things on 100% capacity. You know the equipment throughput, you know what output you can get. Then the question is how to get those investigations coming in. So that's why generally better to do a 100% capacity utilization and then break it down year on year, till you reach say 7, 8, 10 years. Check with similar labs for comparing income targets. This is extremely important. Because you may end up otherwise doing something which is not in line with the benchmark. Okay, if you want to do something very different, then you have to be very sure about it. Otherwise, always better to do a benchmarking with similar kind of laboratories which already exist. Now comes the expense projections. Okay, salaries and wages generally we should calculate on a cost to company basis. That's the CTC. Okay, what we generally do the mistake is to do just the salary which is take home, which is not correct. So if you say that you are center manager or some doctor or something that you want to hire, then you need to also take into account if you are providing him a house, a car, a mobile phone, his mobile bills, travel, all that constitutes a CTC package, right? So whenever you calculate salaries, you should calculate on CTC basis. Also provide for even things like provident fund, gratuity, all of those, which generally is about 20 to 22% of the salary package. Okay, this is generally missed out, and in the end, you land up into trouble. So you need to take a very careful look at salaries and wages. Mind you, in healthcare, salaries and wages, is a big component. Departmental expenses, split that up as consumables, referral compensation, if there is any component of that as percentage of income as per the benchmarks, which are there. Some of you may have 25% as consumable cost, some of you may have 30% or 35%, also related to volume that, your laboratory is going to do. So there will have to be some correlation with what volume you are talking and what is the consumable expense as percentage of income. Otherwise, it is very difficult to come out with a consumable expense. Okay, referral fee, as I mentioned, is a tricky issue. But if it is to be given, then it needs to be budgeted, in an expense sheet properly. Energy costs, I think you also would perhaps be having higher energy costs because most of these laboratories would run 24 hours, 365 days. I remember, once I was invited to walk through Religaire's laboratory in Bombay, in the suburb of Goregaon, and I was amazed that laboratory was 80,000 square feet, and it was fully air conditioned. I don't know how it would break even, that kind of infrastructure when you have to service in terms of, the energy cost itself will be very high, To give you a parallel in healthcare industry, a hospital generally spends about 500 to 600 rupees per bed per day on electricity cost alone. And this is going to grow. I don't think that, we are going to get to. So even the type of, air conditioning equipment that you choose, if you make an intelligent decision there, perhaps you will save fair amount of money, mind you. So generally what you should do is for this kind of, equipment, you should do a life cycle costing, So it's like acquiring the asset and what is the cost of servicing, the asset, say over a period of 8 to 10 years. That's actually the real cost, of the asset. So you should never lose sight of that. It's like buying a diesel car versus petrol car, You generally end up buying diesel car, but if you see maintenance of these two cars over, say, a 5 or a 10-year period, I think petrol car works out cheaper. in the long run. So in air conditioning, now you have very good technologies which are available, which can help you cut your cost dramatically, almost about 20 to 25% less in terms of even use of LED lights, for example. You may feel, why, but I think, in the longer run, because you run 24 hours, it will cut your cost phenomenally. Water, linen, laundry, housekeeping, if that applies to you, I think it does, at least housekeeping, if not, linen, laundry to that extent. Depreciation, you need to cater to, because even though if it is a notional expenditure, it still has to be as per the accounting norms, need to be budgeted for. Loan repayment schedule, if you are relying on loan, then that has to be part of, your expense sheet, and any taxes, if they are applicable. Then comes, the profit and loss, balance sheet, cash flow. All this was Greek and Latin to me when, I started doing this. So then, after you have done the income and the expense, we come up with, the profit and loss, at least the terminology everyone will remember, balance sheets and cash flows. Then there are some things, which is called profit before interest, depreciation and tax, PBIDT or EBITDA, which is an American term, earnings before interest, depreciation, amortization and tax, profit before tax and profit after tax, all right. What it actually means for you to understand is there is a terminology, which is called cash profit and something which is called book profit, all right. So cash profit is something which is here, okay, it's before the interest, depreciation and tax. Depreciation more so important, because you are actually not spending the money, right? You have been allowed to claim depreciation, but no money has been spent. So if you calculate your depreciation and if your losses are less than your depreciation value, you are actually making a cash profit. That means you have cash in hand, all right? Only thing which is not there is, the depreciation. The moment you put in depreciation, you perhaps may make a book loss. Should not bother you, honestly, because, so if companies like, say, Reliance, for example, have huge depreciation, huge, because the plant sizes that they put up is into maybe 10, 20,000 crores. You can imagine even a 2% depreciation, the kind of thing. So, but that gets them the liquidity